Warren Buffett is never wrong. So why is he sitting on $325 billion in cash and refusing to buy stocks? In this video, we're diving into Buffett's record-breaking cash pile, why he's hoarding nearly a third of Berkshire Hathaway's portfolio in cash, and what it reveals about the real state of the market. Is he secretly preparing for a crash the rest of us don't see coming? Stick around because by the end of this video, you'll understand how Buffett's quiet moves signal something far bigger than headlines are telling you, and why ignoring it could cost you big in the months ahead. Oh, and before we start, make sure to hit that like button, subscribe, and turn on the bell so you don't miss out on smart, no-fluff investing insights. Let's jump into why Buffett's cash tells a story the market isn't ready to hear. Welcome to Market Reflect. The man who's crushed the S&P 500 for 3 straight decades is stacking cash instead of buying stocks. That's not just interesting, that's alarming. But once you understand what's really happening under the hood at Berkshire Hathaway, you might start seeing the stock market and maybe even your own portfolio in a very different light. So here's what we know. Berkshire Hathaway just hit another all-time high in cash reserves, $325 billion. To put that in perspective, that's more than the market cap of Netflix, Disney, and McDonald's combined. This isn't just some random blip either. Buffett has been growing this pile quarter after quarter, year after year. Except for a small dip in 2022 when he deployed a chunk of it back into stocks, it's been a steady, almost relentless buildup. But here's where it gets weirder. Berkshire Hathaway is a company built to invest. Literally, their job is to allocate capital. So why is nearly 30% of that capital sitting in cash, not stocks, not bonds? Cash. It's never been that high, ever. People are starting to wonder, is Buffett preparing for some kind of financial apocalypse? Is he quietly anticipating a crash that no one else sees coming? Now let's rewind a bit. This isn't the first time Buffett's gone heavy on cash. Between 2004 and 2007, he also kept his cash levels high, above 20% for nearly 3 years. Then, boom, 2008 hits. The financial system collapses, and Buffett swoops in like an eagle, buying up distressed assets at bargain prices. So, naturally people think, aha, Buffett had insider foresight. He saw the crash coming and cashed up ahead of time. Except, that's not what happened. Look closer. Buffett's peak cash position was in December 2004. But by 2005 and 2006, he was already reducing his cash position, years before the 2008 crisis even began. And Buffett has been very clear. He doesn't try to predict recessions. In his own words, I can't recall ever us making an acquisition or turning down one based on macro factors. He doesn't care about economic forecasts. He doesn't trust them. He doesn't even like economics as a profession. So if he's not forecasting doom, then why is he hoarding cash like a prepper before Y2K? Let's consider something most people overlook: scale. Back in 1997, Berkshire Hathaway was a $50 billion company. Today, it's worth over $1 trillion. That is a 20 times jump. So naturally, the cash pile has grown too. But even after accounting for that, the relative size of the cash, again 30% of the total portfolio, is still unprecedented. It's not just a big number, it's a big bet. Or more accurately, it's a refusal to bet. Buffett is looking at the market and saying, no thanks, I'll wait. But what is he waiting for? It's not about the economy, it's about the price of the market. And right now, by Buffett's standards, the market is ridiculously overpriced. Let's talk PE ratios. That's the price-to-earnings ratio, how much investors are willing to pay for a dollar of earnings. The S&P 500's PE is currently hovering near levels we've only seen twice in the last 40 years. Once in 1999, right before the dot-com crash, and once in 2021, right before the Fed slammed the brakes. But it's not just tech or big names inflating this. Every major sector is looking frothy. Financials, super expensive. Industrials, same story. Materials, also stretched. Buffett's strategy has always been simple. Buy great businesses at good prices. But today, those good prices are nowhere to be found. Now, here's the twist. Holding cash used to be a bad look. Low returns, losing to inflation, right? But not anymore. In fact, we're now in one of the rarest market environments of the past 60 years. Cash is yielding more than stocks. Let that sink in. You can earn more by sitting in treasury bills than by taking on the risk of the entire stock market. And that flips everything. There's a chart that tracks the spread between the S&P 500's earnings yield and the yield on cash. Today, that spread is deeply negative. That's happened only 8 times in the last 60 years. And here's the kicker. Almost every one of those instances lined up with a major market top, including the 1987 Black Monday crash. So when cash pays more than stocks, investors back off from equities. Demand falls, and the market gets fragile, just waiting for a reason to drop. Sound familiar? Here's the part that's frustrating to a lot of smart investors. If this environment is so dangerous, why hasn't the market crashed yet? Why is the S&P still climbing, even though cash is more attractive? The answer lies in another eerie historical parallel, the late 1990s. Back then, we had the same bizarre cocktail: super expensive stocks, high cash yields. And yet, the market kept ripping higher. For years. It wasn't until the recession of 2001 that reality hit. The crash came and US stocks entered a lost decade of underperformance. So the risk today isn't just a sudden crash, it's that we're in the middle of a slow-burning bubble, one that could drag on longer than anyone expects and then snap violently when it finally breaks. And if you're Warren Buffett, you don't want to get caught chasing returns at the peak of that cycle. You wait. You let others chase the froth, and when the dust settles, that's when you strike. This isn't about being psychic. Buffett doesn't know when the next recession will hit. He's said so himself, repeatedly. But he does know when he's not getting enough value for his dollar. And that's where his real genius lies. Not in timing markets, but in knowing when not to play. It's not glamorous, it's not exciting, but it works. Berkshire Hathaway has returned 2,100% over the last 30 years, while the S&P 500 managed just 800%. Most professional investors can't beat the market. Buffett did it by doing what no one else had the patience to do: waiting for the right pitch. Now, not everyone follows that kind of long-term, value-based thinking. Take Bravo's research, for example. They're not waiting for a crash. They've been riding the bull market of 2024 with trade after trade, playing short to mid-term moves, 1 to 3 months max. Their whole model is based on what's trending now, not what's fairly valued. If the uptrend breaks, they flip short. Simple as that. It's a totally different game. Fast, tactical, reactive. But Buffett? He's playing chess while everyone else is flipping coins. And when the next big correction does come, and it always does, he'll be the one sitting on a mountain of dry powder, ready to buy while everyone else panics. Would you trust your portfolio to instinct and momentum, or to the guy sitting quietly on $325 billion, waiting for the market to come back down to earth? Because whether you like it or not, Warren Buffett is almost never wrong. What do you think Warren Buffett's next move will be? Will he finally dive back into the stock market or keep holding on to that cash? Share your thoughts in the comments. And that's it for today. Hit the like button and subscribe to Market Reflect. Stay tuned for more and catch you at the next one.